There are two horses currently ahead of the herd in the stablecoin race. The first horse is far ahead on the racetracks, while the second horse is trying to close in on the gap. Let's meet the heroes, USDT and USDC, the two largest players in the space based on market capitalization. But which stablecoin is going to win the race? In this video, we'll dive into some differences between the two fiat-backed stablecoins. But first, what are fiat-backed stablecoins? So, stablecoins generally come either as centralized or decentralized. Fiat-backed stablecoins fall in the centralized category, and these two stablecoins are the best example of fiat-backed stablecoins. As the name suggests, they are backed by a reserve of fiat currencies in regulated institutions like banks. Ideally, this type of stablecoin is backed by actual fiat currency, such that minted stablecoins can be redeemed for real fiat at a 1-to-1 ratio. The minting and burning processes are tightly controlled to ensure that the stablecoin doesn't stray away from fiat pegging. Now, let's shift our focus to the largest stablecoin in the industry. In 2014, Tether Holdings Limited introduced the concept of fiat-backed stablecoins with Tether USD. This was the first time any company offered its users a platform to trade a US dollar-backed crypto. By tapping into the best of both worlds, Tether opened up cases for crypto in payments and remittances, to name a few. It wasn't long till crypto trading pairs started listing against USDT, therefore giving the stablecoin a first mover advantage in the market. 4 years later, Center, a consortium co-founded by Circle and Coinbase, created US.dollar coin, USDC. So USDC solved similar problems to its competitor, and on top of that, it wanted to ensure that there is the transparency of one-to-one backing. That is, for every USDC created, $1 of USD is held in reserve, either in the form of US dollars or other cash alternatives. This is a big deal for stablecoins, as it is a form of assurance for the safety of investors' funds. Now, we'll go deeper into this later, but in the meantime, let's compare the two assets head to head, starting with volume and market capitalization. The trade volume for USDT is a testament to its popularity. As of making this video, the 24-hour trade volume of the stablecoin clocks in at 28 billion, a higher amount than Bitcoin and even further ahead of its direct competitor, USDC, which has over 2.7 billion in trading volume. In terms of market cap, USDT's has risen to over 68 billion compared to USDC's 45 billion, making it the third biggest cryptocurrency behind only Bitcoin and Ethereum. While Tether is still the clear leader in terms of market cap, USDC has been growing considerably faster, especially last year thanks to the push from DeFi. Earlier this year, the total supply of USDC on the Ethereum blockchain even surpassed that of USDT for the first time. Okay, then what about price stability? USDC's dollar pegging has been solid and tangible slips haven't been recorded in the past year, even in the face of the USD collapse. Similarly, USDT's dollar peg is also tightly maintained and hardly strays away from the 99 cents to $1.01 range. However, USDT suffered a momentary depeg during the Terra Luna fiasco, slipping to as low as 95 cents on May 12, 2022 on some crypto exchanges. Now, let's move on to one of the most important aspects of fiat-backed stablecoins, reserves. Tether has had multiple controversies and has been in hot water with several different authorities due to concerns about its reserves. After its launch, Tether's website read, "Every Tether is always backed one-to-one by traditional currency held in our reserves." However, in 2019, during a court case by the New York office of the Attorney General, a Lorry representative admitted that the USDT in circulation wasn't backed by 100% USD. but instead a combination of different liquid assets, including cryptocurrencies, generally termed as cash equivalents. Now, after the controversy, Tether's website text changed to "Every tether is always 100% backed by our reserves, which include traditional currency and cash equivalents, and from time to time may include other assets and receivables from loans made by Tether to third parties, which may include affiliated entities." In February last year, after a 22-month inquiry, the New York Attorney General reached a settlement with Efinex, the parent company of Tether, accusing the companies of unlawfully hiding losses. Efinex had to pay an $18.5 million fine and is no longer allowed to operate in New York. Plus, it will have to provide quarterly reports on its reserves. Based on the latest reserves breakdown, just under 80% of its reserves are in cash equivalents, and other short-term deposits and commercial papers, with over 99% of these having a duration of 0 to 90 days. USDC is perceived by many as a safer and much more transparent alternative to USDT. Unlike Tether, USDC issuer Circle has been publishing third-party monthly attestations to confirm that it does possess sufficient capital to back each individual token on a one-to-one basis since its launch 4 years ago. The attestation reports are provided by Grant Thornton, one of the top global accounting firms. It's important to note that although the attestation reports provided by Grant Thornton verify Circle's assertions regarding the value of the USDC reserves, they are not audits. Over the past few years, stablecoins have been in the news for controversial reasons, and several attempts have been made to regulate the digital asset. For instance, custodial financial institutions are establishing rules which stablecoin projects must follow to ensure proper accounting and liquidity for every minted stablecoin. Regulatory attempts have also intensified since the tragic collapse of Terra Foundation's UST stablecoin. That said, it may take some time before stablecoins become fully regulated, as there are many hurdles to overcome. All in all, while USDC and USDT are the most popular options in the market right now, there's still a need for increased transparency to better protect investors. Now, this goes for the whole stablecoin space in general. In the meantime, remain vigilant and DYOR even when dealing with these less volatile assets in the industry. So, which of the two is your go-to stablecoin? Let us know in the comments. Now, explore the other side of the stablecoin coin, decentralized stablecoins. Be sure to watch the next video to find out its different types.